Thanks for joining us. I'm Marlin Bohling with you, and we're watching our opening activity on the grain and livestock markets. It's our first trading day of March, and let's dive into this here. We'll go to the corn board first, and we are seeing more weakness as we go a little deeper into the session. Right now, May corn down 4 3/4 cents at 5.42 3/4, and December down just 1/4 cent at 4.70 1/2 per bushel. Now, on our quotes provided by bar chart on the soybeans, we had a big gain early at the opening bell. They were showing double-digit gains there for a while, and now the May soybeans only 2 1/4 higher at 14.06 1/2, and they had been as high as 14.22 1/2 overnight. September up just 4 cents right now. And a quick look at our wheat market in Chicago. We have the May contract 2 3/4 lower at 6.57 1/2. And that's off of its overnight high by about 9 cents right now. In the Kansas City hard red wheat, we have the May contract 4 cents lower at 6.29 3/4. New crop July down 2 3/4. In the spring wheat trade, the May contract is now down 2 cents at 6.36 3/4. July down 2.5 cents. And also looking at that cotton market, we had some big gains overnight. We're showing the last trade on May cotton 276 points higher at 91.59 cents per pound. December up 167 right at 86 cents. And we are joined by none other than Chris Swift of Swift Trading Incorporated. He's based in Nashville. All right, Chris, let's sort out what's going on here in the grain markets. Everything kind of flaming out about 20 minutes or so after we got the market open this morning. Kind of coming off of the highs. What's going on?
Well, I think it's lack of export news. Sunday night we come in and we're all looking for that news to develop overnight, and so we put a little premium on the grains, and then by Monday morning when the actual session opens, there wasn't any exports to it, so they just kind of sell them off a little bit. But we have seen this probably the last couple of weeks now where we're just trading sideways, and the one thing that I note about it is we're not really going down in price. We're just kind of holding here, and it seems to me like everybody's waiting for that next round of Chinese buying to come in.
So it has been, what is it, Chris, 2.5 weeks now, 3 weeks since we've had any overnight sales to China?
Yeah, it's been at least 2 weeks, I know, and although we still feel very certain that they need all kinds of grain in there, South America continues to teeter back and forth on how much product that they'll have and when it'll be deliverable.
Okay, how do you handle this if you're a producer out there and you're still trying to decide just how much acreage allocation you want to have between corn and soybeans this year here in the U.S., and you're thinking about doing some forward sales right now, but boy, it makes that job extra difficult right now with the choppiness in the market.
Well, it does, and the spreads between old crop and new crop probably are the biggest deterrents that we see out there, because nobody wants to sell corn at 50, 60 cents under what it's bringing right now. So it encourages them to empty the bins right now, but is not really encouraging them to make forward sales just yet.
Wanted to take another look at the Dow. Last time we were on here, we had the Dow up about 500 points. Boy, they're really taking the spurs to it today here, Chris. We have the March Dow futures. This is on the Dow Jones Industrials. Up 636 points at 31,548. Look at them go to the upside here today. Of course, they were rebounding on news that Johnson & Johnson got their vaccine approved. And now the U.S. dollar index starting to take off a little bit today. Now we're up another 200 points at 91.090 on the March futures there. So we'll keep an eye on that one, too. That could be a deterrent to ag export potential. We'll come back in a moment, and we'll take another look at our livestock trade. And we'll welcome back Chris Swift right after this. Let's go back to Chris Swift of Swift Trading Incorporated. And we'll take a look at what's going on here with the livestock markets. And Chris, on the live cattle board, we had the April contract 75 cents lower. We're at 119.27. We have June down 72 at 117.70 per hundredweight. Now the nearbys are showing the most weakness. What does that mean?
Well, I think what we're looking at is the winter storm that came through probably impacted the cattle feeder a whole lot more than it did the consumer. And the cattle feeder had cattle to back up on him. They lost a little weight. The feed costs increased significantly. And I just have a sneaky feeling that there's a greater need for that cattleman to sell cattle than there is for the packer to buy it.
So the packer has not been chasing that cash cattle market any higher for quite some time. And now that we're into March, there was some fear last week that maybe they would be able to draw on contracted cattle now for a while and that would maybe suppress that cash market for another couple of weeks. What do you think about that?
And it still could, absolutely. We know that they had been making those forward purchases mostly through December and January. Now we've seen that we even had a heavier placement number for the month of January, and before we had the winter storm, I would dare to say that February was on pace to place as many, if not a few more head in the month of February over last year.
Well, let's look at the feeder cattle. We have the April contract on the feeders now $1.27 lower, and they're trading at $141.30 per hundredweight. And if we look at the lean hog trade, now the lean hogs have been faring better today. We have the April contract up 95 cents now at 88.10, and you have the May contract $1 higher at 89.87 per hundredweight, and that happens to be right on the high of the day right now. So a bit of a rebound here with the first 3 months now showing triple-digit gains in the hogs, but the feeders under pressure here this morning.
Yeah, and the feeder market probably going to stay under some pressure because we note that grain prices have elevated significantly and the input costs for cattle feeders are absorbent. So somebody's got to give somewhere or another. Either the fat cattle's got to go higher or the feeder cattle and corn have got to go a little bit lower to bring some profitability back into the cattle feeding sector.
I was kind of surprised, though, because we have the corn market actually down about 6 cents right now on that May contract, and yet we have the feeders under pressure. Doesn't that make that especially bearish?
Not necessarily, for the simple reason that we've seen corn prices elevate significantly and seen no decline whatsoever in the feeder market. So they're already disconnected by a small portion. So when you see it like this, where you would think that a lower corn price might make for a higher feeder price, I think the whole equation out there is off kilter enough to where just a little bit lower corn is not going to make any difference.
Okay, well, thanks for explaining that. I appreciate it. Chris Swift of Swift Trading with us here this morning. He hails from Nashville. Janet, back to you.